I'm sure you've heard the alarming news. The average 30-year mortgage rate in the United States is at an astonishing 6.6%, reaching levels not seen since August 2, 2007. The housing market today isn't just a small hiccup anymore. It's grown into a giant bubble, the kind that make history books. Think of it like a balloon that's been blown up too big and is about to pop. We're standing at a point where things look pretty shaky, and it feels like we're about to see the biggest housing crash ever. Why? In this video, we'll jump into our time machine and take a quick trip back and discover how the upcoming housing crash could be even worse than the infamous 2008 crisis. We'll dig up some clues from the past, from historical context and inflation-adjusted data to crucial indicators to show you how weird and wacky things are in the housing market that are pointing towards an imminent downturn. So, hold on tight, because this story is not your everyday tale. Inflation-adjusted reality. Let's dissect the true essence of the housing market's current predicament by addressing a pervasive analytical blind spot, the disregard for inflation's profound impact. Many historical charts depicting housing prices fail to account for the pivotal role played by inflation over extended periods, casting a shadow over the actual trajectory. For instance, when someone claims to have purchased a house for $200,000 in 2000, the figure can be misleading without adjusting for inflation. In today's terms, that $200,000 would equate to roughly $356,000. To unveil the genuine scope of the housing bubble, we turn to the inflation-adjusted Case-Shiller, a tool that strips away the illusion of a falling dollar. This chart candidly reveals the stark reality. We have not only surpassed the peak of the 2008 bubble, but have done so in a manner that challenges conventional understanding. This departure from historical norms since around 2012 raises an alarm, suggesting that the impending housing crash might transcend any previous economic downturn, presenting an unparalleled challenge to the stability of the U.S. housing market. Understanding this inflation-adjusted reality is crucial as we navigate the complexities of an impending housing crisis.
During the last housing downturn, leading up to the 2008 crisis, when activity plunged this much, the Federal Reserve paused hiking interest rates and then started cutting interest rates about a year later. Activity continued to plunge for several more months. It's important to remember that monetary policy has what's called long and variable lags. So if the Fed cuts interest rates today, it takes some time to impact the housing market and then the broader economy. Today, instead of pausing or cutting interest rates, the Fed is on track to hike interest rates another 175 basis points, which virtually guarantees that the housing market is going to keep slowing down.
Historical perspective. To comprehend the gravity of the impending housing crash, we embark on a journey through history, guided by the insightful research of Robert J. Shiller and Carly Case, dating back to 1889. Over this extensive time frame, a discernible pattern emerges: a consistent upward trajectory in real home prices. However, the landscape dramatically shifts around 2012, marking an ominous departure from historical norms. The 2008 housing bubble, once deemed absurd, now appears relatively modest when compared to the current situation. The inflation-adjusted Case-Shiller chart lays bare the alarming reality that the present bubble has not only surpassed its predecessor, but has done so in a manner unprecedented in U.S. history. This departure from historical patterns raises concerns about the stability of the housing market, indicating that we are standing at the precipice of a crisis that could redefine the magnitude of economic fallout and reshape our understanding of financial history. Interest rates and bubbles.
Housing prices aren't going to go down while interest rates went up. Then when are they going to go down?
Perhaps prices are lagging. The Case-Shiller home price index has fallen a little bit, but it's nowhere near the 2008 dramatic crash that we've seen back in the last recession. I think maybe in some jurisdictions prices have stayed stable, maybe in other jurisdictions they've come down a little bit, but you're right, on the whole we haven't seen a huge housing collapse yet. But let's speculate going forward. Do you think that day could come? We're talking about a very different fact, the fact that housing prices have gone down.
Could that day come? Yes, of course that day could come. Should that day come? Yes, it should come. Will that day come? I have no idea. You know what I mean? mean, I trade the markets as I see them, right? And right now I don't see it. We'll know when the time comes. And I do think the time comes. I'm a long-term bear. And if I'm a long-term bear, then I do believe that's coming. But I just don't think it's coming until people give up on believing it's coming. So again, you get some kind of squeeze up in the market here. You get the Fed stop raising rates for a while, blah, blah, blah. Then people will give up on this whole recession idea. And I think that's when it will come.
Now, let's unravel the critical role that interest rates play in the formation of housing bubbles, drawing lessons from history. The seeds of the 2008 housing bubble were sown in the years following 2000 as interest rates saw a decline. Over the past 3 decades, there has been a gradual reduction in rates, creating the ideal conditions for the formation and eventual collapse of the 2008 bubble. Post the crisis, the Federal Reserve continued its intervention by pushing rates to new records, reaching a low of 2.6% by late 2011. The consequence? A rapid 66% surge in the real price of homes, a phenomenon previously unseen outside the 2008 surge. The historical data reveals a pattern. Each time such acceleration occurs, it precedes a market correction, aligning with the historical average. This pattern suggests that the current trajectory, which began deviating from normality around 2012, may be setting the stage for a housing market collapse, signaling a formidable challenge for the stability of the U.S. economy. Inverted yield curve. Now, let's dive into a pivotal indicator that has historically forecasted economic storms, the inverted yield curve. Picture the yield curve as a barometer, gauging the health of the economy. When short-term interest rates surpass long-term rates, an inverted yield curve emerges, and history has shown that this phenomenon is a precursor to recession.
There's a big crash coming. 10-2 yield curve is a yield curve that shows the difference in the long-term treasury yield and the short-term treasury yield. Every time this number becomes negative, you can see in the graph that a large recession has consistently followed shortly after. A negative or a flipped 10-2 yield curve means that the market expects a high risk in the near term than the longer term.
Consider the 2022 chart showcasing a deeper inversion than seen in prior years, echoing past economic downturns. Since the late 70s, every time the yield curve dipped below zero, signifying an inversion, a recession ensued, be it in the early 80s, 90s, early 2000s, 2008, or 2020. Crucially, the real pain typically commences after the curve returns to positive territory. Reflecting on 2008, the recession unfolded years after the inversion. Currently, we find ourselves in a precarious situation where the Federal Reserve attempts to push rates to the limit, while the bond market raises doubts. The 2022 chart hints at a potential crisis, as the housing market teeters on the edge of a colossal collapse, with the inverted yield curve acting as an ominous precursor to what may be a severe economic downturn. Investor skepticism and the Fed. Enter the realm of investor skepticism and a critical juncture where financial markets intersect with the Federal Reserve's actions. A notable concern arises as the similarity between the 30-year and 10-year Treasury yields unfolds, indicating a growing belief among investors in an imminent surge of inflation. This skepticism is palpable. Rational investors would typically opt for a 30-year Treasury if its rate were attractive. However, the current landscape reflects an equilibrium where both the 10-year and 30-year yields stand nearly identical. This peculiarity suggests prevailing uncertainties about the economic landscape in the coming years. Investors are contemplating the prospect of sustained high inflation, disrupting conventional expectations. If the Federal Reserve attempts to curb inflation by raising rates, a potential crisis looms large. The housing market, hinging on delicate balances, stands at a critical point. This apparent conflict between the Fed's rate maneuvers and investor sentiment could be the catalyst that triggers the unraveling of the intricate web supporting the housing market, bringing forth a crisis of unprecedented proportions. Impact on homeowners and investors. As we unravel the impending housing crash, it's crucial to explore the anticipated repercussions on both homeowners and investors. For homeowners, the ramifications of soaring interest rates may be felt acutely, especially for those with adjustable rate mortgages or individuals seeking to refinance. The surge in monthly mortgage payments could translate into a surge in foreclosures, flooding the market with properties available at rock-bottom prices. For real estate investors, particularly those banking on perpetually rising property values, new challenges emerge as prices take a nosedive. This scenario could leave investors grappling with properties worth less than their outstanding debt, coupled with diminished rental income. The confluence of higher interest rates and a potential economic downturn poses a dual threat, impacting both individual homeowners and savvy investors alike. The landscape ahead is rife with uncertainty, and as the housing market braces for a seismic shift, these factors could reshape the financial landscape, leaving a lasting impact on those who call real estate their home. In conclusion, the signs are ominous. The housing market appears to be on the brink of a severe crash that could surpass the 2008 crisis. As rates act like gravity, the unknown territory we're entering may lead to the collapse of the massive house of cards that has been building since 2012. The bubble we once thought was the biggest will pale in comparison to what might unfold. If you found this video informative, please don't forget to hit that like and subscribe button. Thank you for tuning in. Until next time, stay curious, stay informed, and keep a watchful eye on the horizon.